Hello and welcome to this video. In this video we are going to have a closer look at accumulation, and I will attempt to demystify the term and explain what it is and why it is important for our trading. Okay, if you have a look at this price chart here, you will see that the indicator has been kind enough to draw lots of accumulation and extended range candles for us. And so when you see a candle like this that's marked off with a white line, what does this mean? And I've had a lot of people writing to me asking me what it is that it means, and so I'd like to spend some time to explain what it is and why it's important. Okay, first of all, the notion of an accumulation candle was something that I discovered whilst trading on the very small time frames. And so I was looking for a way to identify areas in the market where the broker was accumulating orders either to push price higher or to push price lower. And when I was looking at strength information, trading strength information on the 1 minute chart, this gives ample time to study the anatomy of price and how it moves and why. And let me draw it here. Okay, so if we look at perhaps a little price nodule like this here, the reason the indicator has marked these off as being white is because it's doing something called accumulation, so order accumulation. So I'm going to draw this, and let's assume for a moment that we have something that looks like this. So this is a dealing range, and price in this situation here, we use this as the example here, where price comes down into this dealing range and it does something in here, and then shortly after on the other side you can see that price goes up again. So it comes down to what the indicator has qualified as being an area of accumulation, and then it leaves. So what's going on in the big black box? This is the question that I'd like to answer. Well, once price moves in to the area of accumulation, the thing that's very important here is the period of time from point A to point B. This is where price will move over time. So we have point A, point B, point A being the entry of price into this box, and point B is the point where price leaves the box. So we have price coming into the box here. And how does a broker earn money? What are they earning money by doing? Well, they are simply earning money by selling liquidity to their clients. So when price enters here, they know that their clients, their customers, have their orders cascaded in and around these price levels. And so the broker would be a fool to allow price to pass through all of their orders without filling them just by going in between like this. This would be silly. So what they need to do is they need to ensure that they are filling their customers' orders. So this is what they start doing. So they drive price down, and this is perhaps called market manipulation, where the broker moves price to the vicinity of where their clients have their orders. So price will go down, and it'll hit this layer, fill orders. If it's like, for example, long orders, this will perhaps push price higher, a little bit higher. And so the broker is constantly moving price up and down and up and down and up and down, like so. And so now the gun is loaded, but before price leaves the box, we don't know if this was bullish or bearish accumulation. At the point that price leaves and moves up, then we know that it was bullish accumulation. And so now we have a lot of orders that have been filled, so price is just waiting to move either higher or lower, and this pressure will build up. So this pressure, the pressure on price will build up, and sometimes you'll see it because you'll see the lows. You'll have lows that start getting higher just prior to the release, and so you'll have an area at the top that has been respected, and you'll have an upward sloping price structure like this, and price will kind of move up and down and accumulate orders, and then when price can't be contained any longer, then it'll burst up to the upside if we are talking about bullish order accumulation. And so the indicator has identified that, and it draws them like so. And the way it does this is that it looks inside the candles and it analyzes the price, and it looks for this kind of price structure like this. So it's pretty simple and very effective. And so we have two different kinds of order accumulation. We have order accumulations at the tops and at the bottoms, but we also have order accumulation at in the middle like this, and another one just up here. And so what are the difference between these two? Well, let me delete all of these. Okay, so the first one is a top. We have a top up here, and what is this? Well, this is an area of bearish order accumulation, also known as supply. So here you can see that we have price moved higher as rejected, and it's sold off. And at this stage here, we don't know what price is going to do until it breaks below. And so once price does break below, then we know that here we had bearish order accumulation. So we know that at this area we have a thicket of liquidity that is ready to fill orders that will push price lower. And so this is why this piece of accumulation here is very interesting for us. And you can see this one here, when this area of supply was established, it was not a reaction to anything above it. The area above it, which is just one just up here, is rejected, and then it moves sideways. Price didn't come back and kind of feed into anything on this daily chart. It moved away, accumulated, and then moved away again. So this is a very strong area of accumulation or supply. And then we had a test of this area of supply, and you can see that when price went up stabbed into this area of supply just up here, you can see that the indicator, rightfully so, started qualifying bars as areas of accumulation, because when price starts feeding into supply up here, what's happening? Well, the broker is filling orders to sell. And so this is what we try to capitalize on. Price stabs in, we have a rejection, and then price starts to move in and around at these pockets of liquidity at this area of supply, and price moving up and into is simply filling orders. So the broker is, on the small times you'll see this a lot more clearly, moving price up and down to fill orders that will drive price lower. And due to the fact that we have a daily area of supply and price is reacting on it, the likelihood of price being rejected at this level is much greater than price moving through it. So assuming that there is no news, there is no geopolitical announcements being discussed publicly, these areas of supply and demand generally hold. And the greater the time frame, so the daily, weekly, and the monthly, the greater the likelihood that the area is going to hold. So price stabs into that. We have an accumulation of orders, which is very clear here. You can see we have the white candles, and then price is rejected and moves lower. So this is an area of accumulation that is a top, and this is an area of accumulation that is a continuation pattern. So we have another one here. You can see we have another one here. This one is not so clear because you see how price kept drifting lower. This is just a sign that price is having a tough time gaining support, and then it plummets lower. But you can see how these candles here they look quite similar in that they are located next to each other. These ones are kind of drifting lower and lower, but these ones are kind of positioned next to each other. So this is a more stable area of supply here. You can see that price moved lower. We had an accumulation of orders. Before this candle leaves the area of accumulation, we don't know what price will do. We don't know if this is bullish or bearish order accumulation. But the point that price leaves, then you know, great, the same thing applies here as happened up here. We know that we have bearish, we have liquidity here to fill short orders. So when price comes up here, just like happened up here, the likelihood that the price is going to be meet resistance due to the thicket of liquidity to the upside will often result in price moving away from the area of accumulation. And we had some news here, and when this happens, when you have news, liquidity dries up because it's too risky to have liquidity for sale in and around these areas at the times of news. Then price just flew straight through it, so it consumed this one and this one. And when the market slowed down after the news, you could see it reacted nicely at this one just up here. So this is ultimately what is happening within the accumulation candles. And then we have the notion of parent and child supply and demand, and I'll touch on this briefly because this is also a very key part of accumulation. Okay, so we have an area of a supply or demand that is a parent, and we have an area of supply and demand that is a child. And what does this mean? Well, we have this area here, and this area here is a parent. And why is it a parent? Well, this is a parent because this is not reacting on another area of supply to the upside. Price came up, it sold off, it accumulated, and it sold off. It didn't come down, accumulate, and then go back up again and react at the highs or up into these candles. It simply went down, accumulated, and went down once again. We have the same thing going on lots of other places. Let's have a look back a little bit. If we have a look, we can see that we have this one here where price sold off, it accumulated, then it sold off, and then when price came back, it reacted at this parent supply. And due to the fact that this area of supply reacted to another area of supply, the fact that an area reacted to another makes it a child. So this is a parent and this is a child. Let's assume that we have multiple levels of supply here. So let's assume we had an area of supply just up here. We do, as you can see, we had the daily bar stopped and a new one opened, so we have micro supply in this level, so probably 4 hours supply in there. So if price moves down and reacts, the reaction makes the area of supply, demand or supply, a child. And so here we have a child, assuming that this is a parent. So parent, child, and this one reacted to this one, which makes this a child. And so this is the youngest sibling, this is the oldest sibling, and this is the parent, assuming that this was indeed valid supply. Good. Okay, so how do you know if the area of accumulation, supply and demand, is strong enough to trade at? Well, then you have to look at what that area of accumulation, supply and demand was able to accomplish when it managed to move away. And how do you gauge the strength of price? Well, this is done generally by assessing what it was able to do to the market. Was it able to break the structure of price? Well, first of all, you have to ask yourself, well, what's the structure of price? Well, the structure of price is normally discussed in terms of trend lines, highs and lows, and so on and so forth. And this is why we use trend lines to qualify areas of supply and demand and opposing areas of supply and demand. So let's assume here you can see that we had this area of supply. We had a reaction once, we had a reaction twice, and each time price feeds into this area, it's consuming the liquidity available at the area. So each time the area gets weaker and weaker. So it's okay, after this test it got weak, another test it got weaker, and on this test it was taken out. Then you have to ask yourself, well, what area of demand was responsible for consuming this area of supply? Well, it was the one down here. And so this is where price came down to roughly. It came into this candle here. So this is what you want to be doing. Ultimately, when you're marking up your charts, you have to ask questions, and I like to ask these questions out loud to myself because it keeps things clear, and it forces me to discuss these points clearly. So the area of accumulation is strong, is displaying some strength, some muscle, if it is able to break trend lines or consume opposing areas of supply and demand. If we have a look here, you can see that we had a trend line that we could have drawn from. First of all, we have to qualify the trend line points. We have a low. We're going to take the biggest swings. So you go like this. A bit messy. Then you have to ask yourself, which of the two most recent swing lows can we use for this? Well, you can see that we can use this one and we can use this one, so we'll do that. So we have a trend line that looks something like that, very roughly, and then you ask yourself, okay, what area of supply broke this trend line right here? Well, it was this one up here. So this is the one that you target for an entry. You have to choose the area of supply that is responsible for breaking the structure of the market. Because if it's able to break the structure of the market, then it's significant. So this is the one that did it. And here we have a parent, we have a child, and price reacted at the child on its way down. And then here you can see that we had a trend line here. We had 0.1, 0.2, we had a low, and price moved below that, so we had a trend line that was marked like that. And you ask yourself, what area of demand broke the trend line? Well, it's this one here. And so this is where price came down to and tested before it moved higher. And then we have this high here, and so this is significant. So what area of demand managed to push price above this high? This one just here, or something in here did. So this is the area here. And where did price react at? Well, it reacted at this child supply. Let me clear that up. It acted at this child supply just here. The parent is here. So we had a reaction here on the first test, and the second test we reacted on this one here. So we had one test and then two tests, and on the third test price released to the upside. So this one here is the one that is responsible for taking out this high. So you have to always ask yourself which one is responsible for doing what. And if you have an area of supply and demand that hasn't really been able to accomplish anything, then you don't consider it for a trade. They have to be strong. And if they're not strong, then it's best just to either change time frames to look at something that's a little bit more significant, or change pairs. Right, I think I'll leave it at that. There was a lot of information, but I think the information discussed there is paramount to trading supply and demand. It's very interesting, or at least I think so. But again, if you have any questions, please send them in. And until the next video, safe trading.